All right, so in the world of income investing, you've got a heavyweight champion and a brand new challenger is stepping right into the ring. We're going to break down a really interesting analysis that asks a big question. Is the go-to fund, JEPI, about to be unseated? Is the king of covered calls about to lose its crown? Let's dive in.
This is the question, right? It's on every income investor's mind. How do you squeeze more yield out of your portfolio without taking on some kind of crazy risk? Well, for years, a specific type of fund has been a super popular answer, the covered call ETF. So here's how we're going to tackle this. First, we'll look at this new contender on the scene. Then, we'll do a quick refresher on the covered call playbook itself before we properly introduce the champ and the challenger. After that, we'll get into the weeds on why one analyst actually made the switch, and we'll finish up with a guide to help you figure out your own move.
For the longest time, if you were talking about covered call ETFs, you were pretty much talking about JPI. It just became this absolute giant in the space. But the game is changing, and a new analysis suggests that this other fund, GPIX, isn't just a contender, it might actually be a better choice. But hang on, before we jump into the head-to-head matchup, we really need to understand the playbook they're both running. This core strategy is absolutely key, because once you get it, you'll see why the small differences between these two funds matter so much. At its heart, it's actually pretty simple. You own a bunch of stocks, right? And then you sell someone else the right to buy those stocks from you at a set price in the future. Now, just for selling that right, you get paid an upfront fee. That fee is called a premium. And boom, that's instant income in your pocket. Okay, so this is the crucial point, the fundamental trade-off. You are trading potential future gains for guaranteed income today. If the stocks you own suddenly rocket upward, you're going to miss out on some of that growth. But in exchange, you get this consistent stream of cash from the premiums, which, let's be honest, can be fantastic in a flat or choppy market. And that brings us to the reigning champ, JPI from JP Morgan. When this fund launched, it just exploded. It quickly became one of the largest, most popular active ETFs out there, and for some very, very good reasons. JP's success really boils down to a pretty simple formula. It delivered a juicy yield, often in that 7 to 9% range. It did this with a super disciplined, systematic process, writing options every single week like clockwork, and it held a portfolio of more defensive, lower volatility stocks. It's huge, it's liquid, and it has a proven history. It's the safe, reliable choice.
But you know how it is. Wherever you find a champion, there are always challengers looking for a weakness. So enter GPX. This is a newer fund from Goldman Sachs, and it was really designed with a more modern and, as some would argue, a more intelligent approach.
The single biggest difference here, the absolute core of the argument for GPX, is that its strategy isn't rigid, it's dynamic. It doesn't just apply the same formula week in and week out, it actually adapts to what the market is doing. And right off the bat, it's got a direct advantage. The net expense ratio is just 0.29% thanks to some fee waivers. And look, in the world of income investing, where every little basis point counts, a lower fee is a pretty significant head start. So this dynamic approach has a few key features. Unlike JEPI's systematic method, GPIX can change how many options it sells. Maybe it dials it back when the market is trending up so it can capture more of the gains. It's built on the broad S&P 500, and it has a stated goal of reducing what's called NAV erosion. That's kind of the slow bleed of a fund's underlying value over time. Basically, it's aiming for a blend of both income and growth, not just income at any cost. So, with the players introduced, let's get to the real heart of it. Why did the author of this analysis actually decide to switch their allegiance and their own money from the proven champion over to the new challenger? Well, the case is built on 4 logical steps. First, by being dynamic, GPIX can dial back on selling options during a strong bull run, which lets investors keep more of that upside. Second, this flexibility helps protect the fund's net asset value over the long haul. Third, the lower fees, that's just a simple direct cost advantage. And finally, because it has this blended approach, it's a better fit alongside traditional index funds in a core portfolio. Of course, it is not that simple. JPI didn't become a titan by accident, and there are some very strong arguments for sticking with the tried-and-true champion. This decision isn't a blowout by any means. JEPI's defense is formidable. For one, it has a much longer track record. Its rigid, systematic process actually avoids the risk of a manager making a bad tactical call. In fact, in really volatile or directionless markets, that disciplined approach of just constantly harvesting premiums might actually be better. And you just can't argue with its size, which provides immense stability.
And this quote really gets to the heart of the wider debate. Some experts, like hedge fund manager Ben Eifert, are critical of the whole model, arguing that, quote, systematically, blindly selling options is a bad idea. Now, GPIX's dynamic approach is a direct answer to that critique, but it also introduces the risk that the managers might make the wrong call.
So, we've heard the arguments for the challenger and the defense for the champion. And this brings us to the most important part, how you can use this information to make a decision that's right for your own portfolio.
This decision guide from the source material makes it pretty simple. As you can see in the table, if your absolute top priority is defensiveness and having a comfortable, long track record, the checkmark goes to JPI. But if you're looking for better upside participation, lower costs, and a fund that fits more of a core plus income role, well, the analysis suggests GPIX has the edge there.
And finally, just a few crucial things to keep in mind. The author advises starting small if you're thinking about a switch, just to test the waters. Definitely keep an eye on those fee waivers for GPX, because if they expire, that cost advantage shrinks. And please remember, the income from these funds is often taxed at higher ordinary income rates, and they are best used to complement, not replace, your core stock holdings. So that leaves us with the final question. When it comes right down to it, for your goals and your money, what do you value more? Is it the proven, disciplined consistency of the champion, or is it the adaptive, dynamic potential of the challenger? The answer to that will tell you which one might be right for you.